All right, we are going to touch on a popular topic, which is understanding how the cash value grows in a life insurance policy. And in particular, we're going to focus on a split study. And what that means is how much of my payment is directed towards base premium and how much is directed towards PUAs. This is geared towards agents and consumers. If you are an agent in the industry, our training program will cover everything in this series times 30. So there's a lot more details, a lot more examples. This is meant as more general education. So whenever we have a policy, what we're going to go through here is understanding how different areas in a life insurance policy actually work. Because I have my base premium and my PUA rider. Those are my two main components. May have a term rider attached as well, but that'll be minimal. These are the two main areas. Now with any life insurance policy, what is going to grow the cash value over time, aside from my payments, is the interest credited to the policy. And that's made up of two components. You'll see the guaranteed rate, and then also the dividend rate, which will be technically the surplus. We're going to touch on that next. So the main purpose of this entire video series is going to see if I'm going to pay in $1, what percentage should go towards these two areas. And at any point in time, does it make sense to have a higher premium, or is someone telling us that, us as a consumer, an agent is telling us that because for whatever reason, without getting into any details. So let's start to break things down here. So with an insurance company, we're going to go through how the guaranteed rate and surplus works first. So let's assume I have an insurance company. I'm working with a company that has published a total dividend rate of 6%. All right, what does that mean? Well, they credit a gross dividend rate. Remember, dividends are a gross rate credited to policyholders after the cost of insurance and mortality charges. Now, what that element is made up of, that total dividend rate of 6%, I have my guaranteed rate of 4%, and then they declared a surplus of 2%. The two together equate to my total dividend rate. What this says here is dividend column on illustration, and we have it right below the surplus. So whenever I look at a detailed illustration from any life insurance company, sometimes it can be confusing because I look at my total cash value, I look at my dividend column, the company's total dividend rate is 6%, and when I start crunching the numbers, it comes out to like 1.5 or 2%. Very confusing because the illustration will often say annual dividend on the illustration, which makes me think it should be the total dividend rate. Item to be aware of here is that annual dividend column only reflects the surplus. Another way to put it is the guarantee is not included in this column, but that's some excess information. Now, we're going to go into a little more detail here. Here's the important piece. If I have money going towards base premium and PUAs, I want to understand how interest is going to be credited, and if an insurance company favors base premium dollars or PUA dollars, what's going to ultimately drive my cash value north? That's the name of the game. That's what everyone's interested in. So I have a guaranteed rate of 4% with most insurance policies and companies, especially the larger carriers. That guaranteed rate of 4% is exactly the same on any dollars that go towards the base premium or that go towards the PUA rider. Important to be aware of that. Another item to be aware of is the guarantee of 4% is the same, but dollars I pay into the base premium, what happens with a traditional policy the first and second year? If I pay a $10,000 premium, nothing shows up in cash. So what that means, yes, I'm yielding the guarantee of 4%, but there's nothing there to earn 4% because the company has overcharged me for the cost of insurance, the death benefit up front. After that, the guarantee begins to be applied. Now, before I go too far, the $10,000 over here, where does that go? A PUA payment. Cash value. That's money that begins to yield the guarantee sooner because it's in cash value, it's accessible, I start to see it grow sooner. And in the next couple segments, you're going to see examples on this. Now, in respect to the surplus, so assuming that example where I had a total dividend rate of 6%, what that means is my guarantee was 4, and my surplus was 2. Okay. So the surplus, here's where it gets tricky. This is more favorable on base premium dollars, meaning the insurance company's dividend rate, their surplus, everything above the guarantee, their formulas, when you actually break down how an insurance policy works, not to nerd out on you here, but what happens is they do favor base premium dollars. So when you look at illustrations from 10 plus years ago when dividend rates were higher, it would sometimes make sense to have a higher base premium because that higher dividend, that surplus formula, favors the base premium. Meaning, you're going to see a higher dividend number on any illustration the next couple segments or next couple videos when we actually show some numbers here on a higher base premium split. Very important to be aware of this. Whereas the surplus on PUA dollars is not as favorable. Now this can be confusing, and this is definitely one of the most technical topics there is. So, how do I earn interest on the policy, or how is it credited? Guarantee, same on base premium and PUAs. Surplus, the rest of that dividend payout, more favorable over time on base premium dollars. Remember though, nothing shows up in the beginning. So yeah, it's more favorable, but I'm not really getting anything because nothing's there. So I'm out of the gate slower, whereas this one is a less favorable surplus. It's going to be a lower dividend, but on a larger amount of money. Keep that in mind. So other items to consider, because the above can be confusing, and the next series will shed some light on it, the next couple of videos, because we're going to break it down very thoroughly, is what split yields more cash? At the end of the day, that's the main question. Whether that dividend shows $1,000 or 0, my net cash value, which is the money you actually have access to as a policyholder, that's the important piece. So what policy design, what split, whether it's a 40% premium or a 10% premium or 5% premium, whatever it might be, how do I generate the most cash value? Big item to consider, because this is going to affect policies. This is in speaking with insurance companies, how they feel, some of the larger companies too, what they feel is for at least the next 10 years, the low interest rate environment we're in right now is going to remain exactly as it is. They're not expecting or foreseeing interest rates coming back up. Why that's important is in respect to the dividend rates with all life insurance companies, we should not expect them to skyrocket anytime soon. And why this is important is because if the surplus remains the same or goes down, I definitely want to make sure I'm looking at the guaranteed cash values, which one of our videos is going to touch on, and this will help shed more light on what split do I want to go with in the event dividends go down, which one's going to ensure I've got the most possible cash value. That's the name of the game. How do I optimize the cash value of a policy? We'll get into that with some numbers. Hope this helps. Hey guys, Steve Parisi here. If you enjoyed the content you just saw, please subscribe, like, and hit the notification bell for future videos. If you'd like more information or to see some custom policies for yourself, feel free to call or email our offices at the contact information below.